For the benefit of those of you that might be watching this webcast recorded rather than live, we're actually speaking on the morning of Tuesday, the 30th of November. And of course, following last week's discovery of the Omicron variant, the outlook could result in another disruption to a full economic recovery. And that really depends on the path of the strain and how stringent the new restrictions will actually be. This would be in addition to the measures imposed already by some continental European governments over the past couple of weeks to deal with an upsurge in Delta cases. And it's not yet known for sure whether the new Omicron variant is more transmissible, if it leaves people with milder coronavirus symptoms, or critically, whether it's more resistant to the vaccines. But that does seem to be the thinking of the scientific community right now. So, against these many question marks, yesterday we published our own look ahead to next year. It's entitled The Outlook for 2022, Transit to New Normal, but Risk of Delays. Our analysis here is largely based on the new COVID variant failing to have a long-term impact on infection numbers or hospitalization rates, which now I admit is something of a leap of faith. But before we get a more precise roadmap of the way the virus will behave, it's very difficult to charter a change of course for the economy and policy. In short, our main views are as follows. In terms of growth, we've had a decent year globally, as many jurisdictions have been catching up on economic activity as their economies have reopened. We think in terms of world GDP, we're looking at something around 5.5% in 2021. And for our baseline case next year, we're looking for 4.5% economic growth. Probably the most important question, and it's one we get the most questions on from clients, is whether the current burst of inflation is transitory or whether it's long-term. So, for example, we had news yesterday that German inflation shot up to 6% on the European harmonized measure. We think, in brief, that the current situation can probably best be described as the result of a massive post-lockdown surge in demand, which could not be met by increased supply and indeed existing inventories which had been run down. One good example here is the second-hand car market. If you look at prices here in the UK or indeed in the US, they're climbing by around 20% per annum. That is partly due to a shortage of new cars, in short, because of problems with getting semiconductors. Those issues appear to be easing, especially in the specific automobile sector. Of course, soaring energy costs are very visible. Beyond oil prices, which we all know about, there are a number of individual factors as well. So, for example, those of you listening from outside the UK may be unaware that offshore gas prices here have gone up by a factor of 4, which are pushing inflation up very sharply due to their impact on domestic heating prices. And in short, again, clearly areas of price pressure have been sharper and they've been longer lasting than we thought a few months ago. But in due course, markets should be able to work and supply should respond to higher prices and inflation should moderate. And we seem, for example, to be looking at shipping costs beginning to roll off their peak. This process is admittedly taking a while. These things don't happen instantaneously, and it is early days in that correction. But we think in those specific markets that costs should ease back as 2022 rolls forward. The main question mark, and this is what we're most concerned about from an inflationary perspective, is the labour market. And we're concerned about that in the context of inflation because in developed economies, it's extremely rare for inflation to be able to take hold without wages accelerating and looping back into prices. And what concerns us, of course, is that there are a number of well-documented labour shortages in various sectors, partly due to skills mismatches. But what we're also looking at is workers appearing to have withdrawn from the labour force. So, for example, if we look at the US situation, participation rates, which is effectively the proportion of those people that are either in work or wanting to work, they're close to 2% lower than pre-pandemic levels. And that comes to, in terms of over 18s, about 5 million people. Now, we don't know if this is temporary or if it represents something which we could call the Great Resignation, which is some workers retiring early, some people wanting different lifestyles perhaps. In the UK, there's a similar effect. We think it's probably due to more younger people staying on for another year or two at university, but we can't be at this stage 100% sure. If what we're witnessing is actually a permanent reduction in the supply of labour, then wage pressure could actually extend beyond specialist sectors such as HGV or lorry drivers. And we're then left trying to estimate how much extra pay pressure there is in the economy and what the response of inflation is and how central banks deal with that. That's a very big question mark, we think, for next year. A working assumption, though, is that labour market dynamics are not going through a permanent shift. We saw participation rates fall in the US, for example, during the global financial crisis, and we saw a steady recovery. So it's a fair assumption to do it this time, we think. But in any case, we are concerned about some of the labour market metrics, and in particular, the Federal Reserve's favoured measure of inflation, something called the Employment Cost Index, and that shot up by 1.3% on the quarter in the third quarter of this year, 2021. And that's a joint 30-year quarterly high. So, repeat of Q4, and everyone's going to be recalibrating their pictures of the labour market, and we may well have to rethink the transitory inflation story. Looking at the policy response by central banks, obviously different central banks are responding differently. The main direction of travel, however, is that we're beginning to get tightening, or at least an unwinding of emergency monetary measures by a lot of central banks. Perhaps China's an exception here. Turkey certainly is an exception. It's cutting rates aggressively. But if we look at the situation here in the UK, we think at the moment, obviously the Omicron situation notwithstanding, the Monetary Policy Committee is still probably poised to raise the bank rate in December by 0.15% to 0.25%. For now, we're still looking for the bank rate to reach 0.75% by the end of next year. And one point is to note that once you get to 0.5% on the bank rate, which we think will happen in February, this would result in the Bank of England not replacing its maturing gilts in its quantitative easing portfolio. That would be the first major central bank to unwind its QE, although we estimate it's relatively small through next year. That's about 37 billion of gilts that would drop off from its total asset portfolio of 895 billion. In terms of the US, in November, the Federal Reserve announced it would start to reduce its QE bond buying by $15 billion a month in November and December from 120 billion a month. Really depending on its COVID situation, we suspect the committee will accelerate this pace of tapering. So it is finished with QE by the start of March, and that would give markets a clear line of sight to begin raising rates at mid-year is still appropriate. Central case, we're looking for 3 quarter-of-a-point hikes in the Fed funds target range, which would take it to 0.75 to 1% by the end of 2022. In the European central banks area, it's not about rates, it's all about quantitative easing. Markets have priced in a modest risk of a hike next year, but we don't think that risk is actually material. What we should see through 2022 is the end of the ECB's larger QE program, the PEP, in March, and perhaps increasing its small, if you like, regular QE program, the APP, to prevent a cliff edge in the number of assets that it buys. But in any case, we do expect QE to cease in the Eurozone at the end of 2022. And by that point, markets could well be thinking about when the ECB is going to hike in 2023. So again, just to say, in terms of interest rates, we reckon that 10-year Bund yields will go up to 0 by the end of next year. We think the euro will firm to around 120 against the US dollar by the end of 2022. Sterling, we feel, will benefit from an evolution of the global recovery and finishes the year against the US dollar at 148. That's quite a rally, I understand, from the current level of around 134. All this, of course, hinges on the new Omicron variant having a limited destructive capacity and essentially a contained set of measures from Western governments in terms of new restrictions. And of course, we know that a couple of continental governments have already imposed new rules prior to the identification of the new variant, which extends to full lockdowns in certain countries such as Austria. We do hope that the evolution of the world economy should continue to benefit from the COVID vaccination programs, which, as capacity pressures ease, should reopen numerous possibilities for both entrepreneurs and investors. I would love to talk about politics for a bit. We've got midterm elections in the States where the Democrats are struggling at the moment. We've got a new German government about to take office. We've got French elections. We've got a new Italian president to be appointed. There's lots, but I think I've run out of time on that unless you'd like to ask questions in Q&A. Lots more I could talk about generally. You will find more detail in our year ahead, our global economic overview, looking to 2022, if you'd like to download it. But now, time to hand over to Tom Standage for his take on what lies in store over next year.